the point is, if you have a model, and let's say that it's Mythos class or beyond, and you're positioning it to enterprises as, hey, as a part of our license, this one is for your cybersecurity efforts to defend yourself against randos who can get an open model and start attacking and try to hold your business ransom, and for your own software or hardware, in this case chip vulnerability work. That's a more valuable model, right, than what you'd give for summarizing a Teams meeting. Hello, everyone. Welcome to another episode of The Circuit. I am Ben Beheron.
Greetings, programs. I'm Jay Goldberg.
Well, we, as I think any long-term listener of this of this podcast has noted, we start talking a lot more about networking the last few years. We have joked and jested since day one. You've seen, all heard, who's been here from the beginning, Ben's evolution from networking stupid, I don't want to talk about it, it's boring, to now it's the great interconnect and networking and transceivers is the glue that makes AI interesting. Um, but in that vein, a lot has been going on around this optical conversation, which we haven't spent a ton talking about optics. We have both written about it, and I know you and I have both independently researched this quite a bit. But it's time to double click, I think, a little bit more on networking. And we're going to lead into that through both Coherent and Lumentum's earnings this week that happened. Different tones, obviously different reactions. So I'll let you start with the both of those, and then we'll dig into some of the implications and observations around the networking and optical environment.
Sure. Lumentum and Coherent both reported this week. I don't have the exact numbers in front of me. Lumentum beat across the board, guided up. Coherent was revenue guide was good, but struggled with margins and a few other things. And there is a big divergence in their stock prices this week following those results. And I think it's interesting because both of them are participating fully in this AI build out, optical build out. It's big. We've talked about it a lot. So they have good revenue, but there is not all things are the equal. There's a lot of devil in the details of what they're actually selling, and that is conveyed through their margin profiles.
Yeah, I mean, I think correct me if I'm wrong, I think most people were pushing on kind of their gross margins. There was some interesting conversation on both of their calls about what was going on around both 2-inch wafers, all the way back to 2-inch wafers, 4-inch as well. I think, Lumentum was pretty clear. They were going to be able to use some of those IP from those two to also go into NPO, which I think made people happy. But it's like the industry's moving into 6-inch wafers, and 6-inch wafers is sort of the yield, right? And sure, going to 6 inch is going to help, but you still got to squeeze everything you can out of your 4 and even your 2-inch, right? From what Lumentum said.
Right, right. So semiconductor economics 101, the size of your wafer matters a lot. The more wafers, the more chips, the bigger the wafer, the more chips you can fit on it. And so there's been a long history of moving towards 300 millimeter wafers for digital logic. We're seeing this transition now to 6-inch wafers for optical components. And Lumentum says, hey, we've got 4-inch and we're doing really well with that.
Yep.
And Coherent, sort of, I guess, perceiving that they're behind, is pushing really hard into 6-inch wafers, which theoretically should offer much, much better gross margins. Because again, for the same wafer, you can get a lot more chips out of it. But that's not actually playing out. And there's lots of debate about why that is exactly. And I think the thing to keep in mind is that 6-inch indium phosphate wafers are brand new. It is not a mature ecosystem. And these things take years to develop. And so you got to change the tools and a lot of the fixtures within the tools, and the wafers themselves. There's not actually a good supplier of. There's only one supplier of indium phosphide 6-inch wafers, and and they're very new to it too. So seems to be some growing pains there. I mean, it's not, this is normal stuff. It's just like it would be better for Coherent if this were a few years more advanced.
100%. And I think, what, there's two things I keep coming back to. I have been very vocal on the Twitter sphere and others, and we will have guests in the upcoming months that can help us talk about the timing, adoption rate, attach of optical. Um, but there's two things that I think are going on, which is leading to people to be a little bit too optimistic in the attach rate of all of this optical stuff. Again, outside of LPO, which is sort of the standard today, right? It's a giant plug. You go and stick it in, and it's at the edge of the board. It's not into the board, um,
Right.
and that's what most people are just starting to ramp, like today. Like your standard optical is LPO, so we're not even at NPO yet, and NPO is right the next version that takes this onto the board, but it is still not like into the die, which is the goal of CPO, and then past that is scale in, which is onto the substrate.
Well, so
That's
yeah, so there's three acronyms we got to dive
Yes,
into
and that's what
there.
I wanted to do. We need to clear
Right.
this up. Okay,
Right. So there's LPO, which is what we've been using for a long time, which is
luggables.
pluggable. You plug in an optical module into the server. The next step is you're going to plug NPO. You're going to plug the instead of going to the server, it'll go onto the board.
Onto the board. Near packaged optics. Yep.
Near package optics. On the board, it's still some extra components in there. The holy grail, if you will be co-packaged optics, CPO, which is where you attach the fiber strand directly to the chip. And there's all kinds of savings and interesting things, important things about that. But as you can imagine, it is very, very, very complicated to
Yeah.
manufacture.
The one thing I want to point out about this, and I have had numerous meetings on this, and this is going to get hot at OCP Summit here. Obviously, we just had OCP Taiwan, and I followed a whole host of notes that came out around that. Um, there is the conversation to exactly like you said, which is the benefit to CPO is obviously you squeeze out more picojoules per bit, yes, and that leads to economics. I do think though right now it is highly debated how much of a savings that is, and is it worth that additional headache over NPO, which again is in its infancy. Like we're not even really at CPO, despite people talking about that at any kind of scale. It's very very small. Um, and that dynamic I think is one of the things that'll have to get worked over because it's so hard to do CPO. um, there's a whole lot of things, not just manufacturing but reliability, like so much stuff's got to get worked out. That I guess my point is, if the savings is not some significant percentage more versus the engineering effort, it's kind of why I think NPO kind of lasts for a long time. And I think this is debated right now about how much savings are you actually going to get per the engineering effort that's going to need to go into CPO is still a debate. And I also think it's just worth pointing out this is absolutely the wild, wild west of connectivity. OCP Taiwan just had a standards paper come out. It's like 300 long. Light Matter helped lead that along with a host of other names. Lumentum is not on that list, and I do not believe Coherent is either. From obviously, they're not in a position to necessarily want a standard at this place, given their spec in. But it's the wild, wild west. Everybody is doing their own implementations, their own custom design for optical, where they're using optical, whether that's OCS with Google or LPOs moving to NPOs. Today it's the wild wild west, which makes this much much more difficult, much more unpredictable. We don't even know which direction this takes in fiber cables, in a whole host of other protocols. So there's that, right? Any early cycle, and so people just keep getting ahead of their skis of the optical trade is coming, these companies are going to be gigantic. It's like this is a very slow roll. And then the other part that I notice is there's these conversations: scale up, scale out, scale across. And what's interesting is like a lot of people are using scale up when sometimes they mean scale out, and that is also confusing people because scale up in some people's nomenclature can mean vertically, so within the rack, and then also rack to rack. So you're scaling up is north to south, rack to rack, but also east to west, the rack right next to you, right? Because it needs to be say 3 meters, right? If you want to do or shorter, right? To or longer, sorry, to go to optical. And so then some people are like, oh, look at how many connections you're going to need inter rack. That's going to just boom CPO. And it's like, no, no, no. Inter rack is so far. I mean, sorry, within the same rack is so far off from adoption. Rack to rack is starting to happen, but they're assuming when you say scale up, right? You know what I mean? Like I'm totally confusing everybody. But my point
Yes.
is, my my point is, scaling with optical within the rack is much farther off. Rack to rack is what everybody's doing right now so that you can have the throughput you need at 800 gig to 1.6 and beyond at more than call it 4 meters, which is what AECs kind of tap out. Um, that I think is confusing people because other vendors use scale up to mean with inside one rack and scale out to mean rack to rack. And so we have this mixing of terminologies that's confusing people, leading them to assume that you're going to have far more optical connections when you're probably not, because you don't need as many to go to the rack right next to you. Anyway, I'm sorry. I'm
You
sorry for confusing everybody. I'm just this. The
you
nomenclature is throwing people off.
you are going to be fighting this fight. You're going to be tilting at this windmill for years. Just, this is not the
Great.
first time you brought this up,
I know.
or even the second. No one's ever going to agree on this.
I,
I, I
I, I know, but I think it's worth knowing because if you're going to make an assumption of attach an optical content per rack, you need to know if it is within the rack, within the vertical of the rack, which is not happening. It is rack to rack, or it is pod to pod. So at distance, 100 meters away. Very far less optical content in both of those two latter scenarios. So you need to know what we are connecting if you're going to make an assumption of optical content attached per rack.
that's a fair point, but I'm confused by all this because we're in this bizarro world where I always think of myself as the ultimate optical bear. Like I've talked about this before. I hate covering optical because I've covered it for years and it always disappoints. But like I'm more bullish on the optical build out than you are. Um, I think in 2028 we will start to see certainly certainly NPO in
Yeah, MPO
production
for sure. Absolutely.
and some CPO to some degree.
Right.
Right, I think that's
But
coming.
again, horizontally, not vertically within the rack. You have to have NPO perhaps. Yes. NPO can start to happen in the rack because it has to be serviceable. The density of connections out of 500 and something plus GPU rack is so much optical, right? In terms, you need so many more switches in that to make that happen. So the optical content once that happens is enormous, and it has to be serviceable, which is what NPO comes in. I can see NPO in that rack. My point is that you've got Lumentum out there going, we're doing CPO and we're starting to scale. And then people go, oh, by CPO, you mean, or they're saying scale up. Like Lumentum's saying scale up when they mean rack to rack, not within the rack.
Yeah.
Because, and that's confusing people. Like you'll see them make these diagrams, like these bots or whoever they are on Twitter is like, look at how much fiber you're going to need in one vertical rack. And I was like, no, NPO, yes, not CPO in in within the same rack,
It,
north to
but
south.
it's coming. It's coming.
It's coming. It's
We
coming.
can debate
NPO,
timing.
not CPO,
CPO is coming too for
not in
scale. Yes.
rack, not in
Yeah.
rack. You can't
Yeah.
service that fiber. It's gonna
It.
die. It'll just kill boards and GPUs.
I think it's. I still think it's coming. It's gonna. Now here's the thing. It's optical. It's going to take longer than any of us expect.
Yeah.
Right. It's always going to take. It's always going to come later. Um. So be warned on that. But I think it's possible.
Yeah. I mean, I'm not saying it doesn't show up. I'm just saying it doesn't scale. It's not going to be the vast number of attach of compute racks. It just doesn't scale. The manufacturing bottlenecks here are too deep Like all you have to do is dig into how hard this is to manufacture. You can very quickly come up with some decent estimates of how many connections can be made, and GPU racks, accelerator racks, CPU racks will outstrip that by magnitudes of its ability to manufacture at rack scale.
Just so everyone knows, this is not just Ben and I having this debate. We have several guests lined up to take both our sides in this. Um,
Okay, let's move on to Cisco. In the networking trend, like that's optical. Let's move on to Cisco.
Cisco, which I'd sort of stopped paying attention to years ago because it got very very boring, is not boring anymore. They reported their quarter. I don't. The numbers were, I guess, disappointing. They looked okay to me at my eyeball, but like the street, it's down. It's down a few percent this week on those numbers. But I read through their transcript and I thought there were some really interesting things about it. Right. For one, they are almost entirely use their own silicon now. Silicon One is their internally designed silicon. They were doing custom ASICs before we even called it custom ASICs. They've been doing custom their own silicon for 20 years, um, but it's now pretty much all of their portfolio runs on their own silicon, which I thought was pretty interesting. It's much more advanced. They also went out of their way to say repeatedly that they're doing it themselves. They'd
Yeah.
used MediaTek for many years, but they now have all that capability internally, which is something to keep in mind when you look at other companies' custom business. But I thought, they're now getting a fairly healthy degree of AI attach, and I think the knock on them for the last, I don't know, pre AI 10 years leading up to that was that they really didn't have a presence in the cloud. Hyperscalers all wanted to build their own white box switches, and so Cisco was sort of shrinking relevance in the data center. And AI seems to have changed that. They have a really good AI attach rate across all kinds of switches, uh, right? And all kinds of hyperscaler wins. They talked a lot about on-prem enterprise building up their own switches, using
Yep.
Cisco switches to build their on-prem AI clusters. And the thing I thought was most interesting, they talked a lot about their use of Mythos. They apparently have a license from Anthropic, and they allow their customers to run basically security audits on enterprise IT systems to go through Mythos, like full, no guardrails kind of Mythos, like the full Anthropic, and that is exposing all kinds of security vulnerabilities. And I thought this was a pretty smart sales tactic for Cisco's security business, is because they allow you to do this audit probably for cheap or for free, and of course you're going to find all kinds of vulnerabilities, and then Cisco would be happy to patch those for you for a fee. And I think where this is particularly interesting, you think about like Cisco stuff. There's Cisco switches everywhere. Some have been around for a very long time, and they're all end of life. And Cisco stopped patching them years ago, and now people are finding vulnerabilities in sort of core switches. And I think it's a very smart sales tactic on Cisco's part, because now they're able to charge for hardware that they haven't had on license in 10 years. But it's an interesting AI use case where Anthropic and Cisco are working together. Um, it's pretty clever.
Um, so I want to talk about this a second because I have heard similar use cases now popping up all over the place in some CSO cybersecurity conversations that they're using Mythos for um, for security vulnerabilities, product testing, um, trying to find vulnerabilities, etc. And I actually somewhat predicted this in my cybersecurity report, where I said that the frontier labs are going to be very well positioned to work with these companies on their security and cybersecurity efforts. The question I have is, and we have no evidence of this, but I'm just throwing this out as a theory. But I have to imagine Anthropic, and to the degree that OpenAI know this, like yes, we know they charge these large enterprise licenses. So all of these businesses are buying a bulk license and paying them a bunch of money. But I have to imagine like that they could charge, or they are charging, or they should charge more for the cybersecurity efforts, or a model. Let's just say that they develop a new one. So Mythos is great, but they develop another one just for cybersecurity. I feel like you could charge more for that. Like that would be an economically higher license given the problem it's solving for the company, but we don't know what the economics of that look like yet.
Yeah, we don't have a good picture of Anthropic's economics and their business model. One of the they filed to go public, and so hopefully soon we will get to look at all that juicy good data and learn about it more. My strong suspicion is that they are under monetizing Mythos at this point, um, just because it's new and they probably don't know how to charge for it. But you could absolutely see the value. Like in the Cisco case, is a good example of how they can do this because Anthropic's story has long been that they are very focused on selling AI to the enterprise, right, as opposed to OpenAI, which is doing a lot of different things, including a big focus on consumer. And I think the sort of um, the heuristic that people have in their minds is that Anthropic is doing it better than OpenAI. I don't think that's true, but I think that's the bias a lot of people have, and because of that focus in the enterprise, and in fairness, OpenAI has a pretty good enterprise business now too. But both of them, like, how are they charging for these things? Where's the money actually coming from? Is it millions of us signing up for $200 a month, or are they actually generating far more money from their API, their enterprise grade API? I'm super curious about that. We just don't
Yeah,
know. There's just not a lot of data out there about it for obvious
agreed.
reasons.
But I think it makes sense, right? Logically, the point is if you have a model, and let's say that it's Mythos class or beyond, and you're positioning it to enterprises as, hey, as a part of our license, this one is for your cybersecurity efforts to defend yourself against randos who can get an open model and start attacking and try to hold your business ransom, and for your own software or hardware, in this case, chip vulnerability work. That's a more valuable model, right, than what you'd give for summarizing a Teams meeting.
Make me another PowerPoint. Yeah. No, I mean, we haven't really touched on this, but there's obviously been this big debate going on right now about Chinese models, open source models. And I don't think we need to get into it all because it gets very complicated very quickly. But again, the sort of the understanding in lots of circles right now is that Chinese open source models are almost as good as Frontier Labs up to and including Mythos. And those, they are free. I say with air quotes, free.
Yeah.
Um, and so I mean, there's a headline in the Financial Times today is there's a price war going on between Anthropic and OpenAI. I don't think we know how any of this is going to play out. The Chinese models may not stay open for free. The Frontier Labs are still moving forward pretty aggressively, um, but it's all wrapped up in that debate. And I think this is one of these big areas where I just say, like, we don't know how this is all going to play out yet. It can go a lot of different directions, right?
Yeah. Okay. So interesting stuff, networking, security, all of those things. Let's pivot to applied materials.
AMAT.
Um AMAT. So I mean, it was extremely bullish. They're benefiting from something I've been thinking about, and I tweeted this called LTA waterfalling, which I think this is very interesting as it relates to kind of all we've talked about, right? That the dynamics of this industry has changed around these kind of LTAs, or as SanDisk likes to call them, new business models. Micron likes to call them SCAs, whatever. These are just customers coming to them going, I'd like to secure capacity for a long period of time. I'm either going to tell you exactly what my visibility is, or in some cases with Micron and memory and even Sandisk, prepayments are happening to secure that, so that the company, Micron, maybe your favorite CPU company or whoever, can go and secure downstream their supply chain LTAs they need as well for substrates, for wafers, for foundry, etc. So you're getting this kind of like company A, who's very big, right? They're the key point supplier, gets an LTA. They're like, cool, I'm gonna go sign LTAs with my suppliers because I need to make sure I have the scale I need to meet the commitment I just gave to one customer. And so you're getting to go down. So I thought it was interesting that even at the wafer equipment level, this is sort of the first time we've heard this type of language around wafer equipment from AMAT that they have 8 quarters of visibility. And and what's interesting is that in prior cycles, they've only had 2 quarters of visibility, was the best their customers gave them. Now they have 8. To me, this is very telling. Their business is growing, revenues were up. I think the one knock, which I have a theory on that I haven't told you yet, so you're gonna hear it all fresh for the first time, is they were very hesitant to guide. Again, their last time they said is we think we're going to grow more than 30%. They're just saying now meaningfully more than our last number, but they didn't want to give away a full year guide for next year yet. Now they have an October investor day coming, but I have a theory as to why they did not want to do that right now, and they probably will at their investor day, which I'll save after you give your take on Applied.
All right, so let me back up. Applied Materials reported yesterday. This is Friday, August 14th, and I I think they delivered very strong numbers. They revenues way above revenue was a little bit above expectations. Earnings for both the current and the guided quarter were significantly above expectations. So they're doing well, and they're raising prices effectively or selling better, more expensive systems. Really good numbers, right? Objectively, in absolute terms, very strong numbers. It was the fastest sequential growth they've ever seen in revenue growth, right?
Yep.
Historic, right? Right? There's a cycle, we all know about it, and they're benefiting from it. But it wasn't enough.
It's never enough, Jay. It's never enough.
I was pulling my hair out listening to the questions on the call. They were all some variation of, yeah, good quarter, but we want more. I'm just like, it was very telling. Right, there was one question somebody asked. I won't name the analyst. He said, "Your customers are all talking about 5-year long-term agreements, but you're only talking about 3-year long-term agreements." I'm just like 12 months ago, it was unheard of to have a 1-year long-term agreement. Now we're debating 3 years versus 5 years, and so yeah, the street wanted more. Stock is down 5% today. Expectations were apparently higher than street printed consensus. So it goes. What's your theory on?
Okay. Well, two things. I'll give you my theory, but let's do this. The two parts from their call that I also think were interesting was, and this is going to lead to my theory. So one was they said customers are finding creative ways to free up clean room space for more equipment. So that's just reorganizing, I don't know, moving a machine somewhere, decommissioning something somewhat. They're like figuring out how to say, I've got this clean room space. How can I get a couple more, a couple more tools in here in order to do that? So there was that. The other one they said was customers are, or they alluded to pulling in some construction timelines to get their fabs out sooner. Cool. So, all right. So you got those two things. Also, wafer per square footage, right? So they have machines. They have a whole line of machines that gives you better wafer output per square footage. That's starting to come into play for some of their things. Cool. Okay. I think that they did not want to give this number yet because of Intel. I think Intel's capital raise is just happened, right? And they have not told them how many machines they want yet over the next 2 years, because they first needed to get the money. Then they need to go very quickly place those orders, which is going to happen before their October day. And I think Intel is also doing what I just said, which is going to use some of this CapEx to accelerate data center or clean room construction. And so I think they were waiting. That's the variable. Intel is the variable you just raised. You're going to spend this CapEx capacity. You needed this money that just happened in order to figure out how much faster your fabs can come online, and two, how much how much machines you're going to need, and Intel has not told them yet. So that's my theory, is that Intel is the variable. Intel will 100% do all of this before the end of October because they have to, and then AMAT will know how much Intel is going to need.
I think that's true. I definitely my spidey sense during their call was there was like the unspoken guest on the call was Intel, like the one thing we're going to talk around and not actually name. Um, I think you're right. I mean, in there, I mean, another simpler alternative is that they just didn't want to guide for the year because companies don't like to guide too far in advance. But yeah, I think Intel is a prime cause of uncertainty at this point. So okay, I buy that.
Um, okay, good. Well, I'm glad you don't know. Anyway, I think it just makes sense. I think it's logical. But I say all that to say it felt like even the notes I read afterwards, like that seemed to be the only real negative. Like, yes, you were like, hey, they expected more. I agree. But they felt like they were being conservative in their guide. And my point, and they were. And my point is that's because of Intel. And at their October day, this will all be settled.
Yeah, and just to be clear, when we were talking about conservative on their guidance, they're still guiding to record everything. It's just
Record
not
everything.
record. That's not record enough. It just
To be honest with you, maybe you could just briefly explain this to me. So maybe we've talked about this, but like, so I tweeted out, I was like, look, I think broad consensus right now is moving wafer equipment toward 300 billion or north of 300 billion by 2030. Yes, there's some things that could move that forward, but then somebody tweeted me back and they were like, the buy side's at 300 billion for 2028. And I was like, why is the buy side kind of consistently more aggressive than the sell side? I don't understand that.
so a couple things. One is I think this is a symptom of just Wall Street in general, where and this applies as much to optical we were talking about before as it does to semi cap. Is there is a tendency, a bias on the street to expect things to happen sooner than they actually do because we're all on 90-day cycles. We're all thinking 90 days, and we're like, oh, that's 6 quarters away. That's a long time, right? Remember, most people don't have models that go beyond 2 years. So there is Wall Street's in a hurry, right? That's the bias. Um, as to why there's a divergence between the buy side and the sell side, I think that's because the sell side is in public and will be more likely held to account for that number, right? If I put out a number now for a prediction for a year from now, somebody's going to come and ask me in a year. They said, "Hey, you said this a year ago," right? And when I say somebody, it could easily be like, I'm on CNBC and somebody asked me a question about that. A reporter asked me like, "Hey, didn't you predict this?" Like I get that. I get those questions a lot. You predicted something last year. Did it come true or not? And you're for the most part, the buy side doesn't make public predictions, right? And just the idea that there is a buy side consensus is a little hazy too, because it's not published anywhere. It's just like 10 guys in a room, 5 guys at a bar, coming up with a number. So I think that's the disconnect there, right?
But okay, fine. But like, I guess I just don't understand why that. I don't understand why that makes such a big deal and can actually impact a market or take it off. Like that their expectations weren't met, and so it's down.
Well, because the buy side are the people with money, and so what they are expecting matters to their stock purchase decisions or stock sale decisions, right?
Okay.
And you know that's they have expectations, and they matter in the degree that if those expectations aren't met, then they're going to change their investment decisions.
Got it. Okay. All right. Well, anyway, that's that. Good stuff with wafer equipment. They've got, like I said, October Investor Day. They've got Epic coming up as a launch. Um, I just, the point I want to end on this is like, even with SanDisk's day yesterday, everybody just keeps talking about how in the deep of the weeds of this supply chain, uh, all of their customer engagements have changed, and I just this is not lip service to the degree that people think like this is a structurally changing dynamic of how you need to shore up your supply chain. And the best supply chains in the world are making these longer term agreements and so that they have the demand. Like that's so much more structural than, do you know what I mean? Than cyclical. Not to say that doesn't. I just think people have to grasp how important the customer dynamic change is, and that's significant. And I just think that gets missed in a lot of this analysis.
I think there is a disconnect in timing. Um, Long term means different things to different people, and I I, mm, I don't want to be totally skeptical about long term agreements. I think there is a qualitative difference between this and past cycles, um, but we haven't tested any of those. Right? We'll see what this looks like in 3 years, 4 years. In the meantime, it's great, and it's going to be different than the last past cycles. I agree with that a lot, but it's not going to. We're not ending cyclicality, right? We're changing the curve maybe.
Yeah, structural floors, new structural floors. Okay, all right. Let's move to NVIDIA and NeoClouds. Um, I haven't talked to you about this, so I'll be very curious on your take. I watched the CNBC roundtable with Jensen and all these CEOs. Um, this this was controversial. A lot was done by NVIDIA and others to kind of make it less controversial. Um, but I think there's something interesting here. I sort of disagree with one of Jensen's points, so I want to talk about that. But I want your first reaction.
Right. So the big news at the start of the week, really still dominating news cycles, is NVIDIA and six large financial institutions are putting together a platform, air quotes again, a platform to provide up to $500 billion of data center financing. And that's a big number. NVIDIA seems to be saying that they're going to effectively back 25% of that, which is significant. Um, but beyond that, we don't know a lot. They have not revealed many details, not least because they haven't actually finalized the agreements, and uh, lots can still change. Right? It is interesting to me. I don't quite understand why Nvidia did it right now. Like, why not wait a couple weeks until everything's signed? Um, because, like, let's face it, Nvidia will press release before things are totally ready, and sometimes they never get there. Right? That's what happened with OpenAI last year. Um, so the deal could end up being very different. But let's just take it at face value. Nvidia is launching $500 billion of financing uh, to build Nvidia based data centers, and it's a big number and has people freaked out.
Okay, but what did you take of Jensen's like points about? I'm trying to address the circularity by pointing out that we aren't just all selling to each other. We're selling largely to sovereigns, to nations, to enterprises, which is the point I keep making. Like when people are like, "Oh gosh, they're just all circling to each other," it's like, yes, but this crew of infrastructure providers, labs, and model companies is gearing up to sell to 300 million plus enterprises worldwide, ex China. I'm not including China in that number, and all of their employees as the tip of the spear of adopters. Like it's B to B to B to B to B, like long sets of B2Bs. And so that's a very big customer base who's going to pay the OpenAIs of the world, the Anthropics of the world to run compute on the infrastructure that passes to NVIDIA, et cetera, et cetera, et cetera. So I often feel that gets discussed. Jensen just, in passing does that, but he didn't deeply dive on that, but he sort of made that point. So anyway, I feel like he tried to do that, but I also wonder if like, again, part of this is just he does want that diversity of NVIDIA GPUs out there in the world from as many sources as possible so that there's just a giant pool of NVIDIA compute that can be there to absorb the coming demand of all of the enterprise.
So I'm of two minds about this, or there's two sides to this. One is to some degree, this is just vendor financing. You go buy a car, and you are borrowing money from Toyota or GM or whoever's selling you that car, right? That's pretty straightforward. And NVIDIA can also argue that they're going to probably have revenue share in this, and they're investing in this great hot new category. Okay. The flip side of this is, it's like I keep saying, there is a very fine line between enabling your customer to buy something, enabling demand, and then actually creating that demand where it doesn't exist. And I'm talking about demand for compute systems. Whole other debate about what the end of all those B2s are, where the end demand is there. That's a whole different topic. I'm just saying, if NVIDIA did not step in to provide financing for these deals, the deals presumably would not get done, right? And so there, you either have to believe that one possibility is that, and this is what NVIDIA is arguing, is that the market, the capital markets, do not understand this opportunity and they're mispricing it. And so NVIDIA is going to step in and bridge that gap to fix the pricing until everyone else figures out how genius it is. The other alternative is that there is like a lot of bubbling going on, right? And Jensen actually posted on Twitter a little bit of more about this than was in the press release. And one of the things, he actually asked that question, is this circular financing? And then he has a whole bunch of words, none of which are actually answering that question. And so I think there is a degree of circularity here. You borrow money from NVIDIA to buy NVIDIA products. How bad is that? We can, there's two sides to that, but I think this just the sheer size of it. I mean, half a $1 trillion is a lot of money. It has people a little bit on edge.
Yeah. So I'll say two things. I am completely on board that that this infrastructure makes money, that there is an attractive return on capital, and I'm saying this broadly, not just for NVIDIA. I'm saying this for custom ASICs. So the hyperscalers and others, I get the sensitivity of the neoclouds because their business is just AI, but again, I think over the lifespan of those assets, they will make money. I guess where I'm not totally solved, and I would say I'll explain why, is the idea that compute is an investable asset, as Jensen says, because I think that necessitates that they're never good enough. That compute is never good enough. Because I feel like it means that if you're going to keep investing in compute, and compute is an investable asset, it has to maintain next generation's attractiveness to put into your data center. Not that I can build it all and then it just sits there and depreciates and it's good enough and I don't need next year's products anymore. Maybe I'm wrong, but that's how I'm thinking about it. That it kind of has to, I have to keep investing in it. It has to be good enough to push the TCO that I keep investing in it. I don't invest in it and stop investing in it. It is my point.
I think this is a fundamental dilemma at the heart of NVIDIA's business model now, which is they need to keep coming out with new systems. They need to keep raising prices on that, selling them for much as they can to keep numbers moving. But at the same time, they are taxing the balance sheet of their customers to a high degree. And that sounds very bearish, but I think there is a plausible strategic rationale here, which is NVIDIA wants the neoclouds to exist because they would rather sell to 200 customers than to 5 customers who have all the power. It's a very, very different dynamic. And so I get, I mean, part of my issue here is that there's a lot of like bubble talk in all of this discussion, rightfully so. Like a lot of Jensen's tweet was kind of bubble speak. And so I think that rightfully makes people a little nervous. But there is a strategic rationale here, which is, I mean, it's become clear over the last month is the race for AI is as much about capital as it is about technology. You have everybody going into debt, burning the free cash flow into negative territory to fund this build out. And I don't think the payout is clear. I'm not saying it can't exist. I just don't think it's clear. You have to put some pretty heroic assumptions into your models to really get these to pay off. That being said, we did have CoreWeave and Nebius, the two leading neoclouds, report this week. Both had good numbers. Both saw very strong positive stock reaction, and I think there is a short term case here and a long term case. The short term is if you can buy NVIDIA, if you buy GPUs today and get them deployed, you can pay those systems back in under 2 years. Right? Nebius said this on their call. It used to take them about 3 years to get payback. Now they're at 2 year paybacks. Both companies talked a lot about how they're renewing Hopper and Ampere systems for much higher rates than the previously. Prices are going up, and so I don't disagree. In the near term, if you have compute, you can sell it, right? But less clear to me is the extent to which those two in particular are very dependent on a small number of customers, the hyperscalers and the frontier labs, who are all now building their own data centers. And so it gets a little murky because we have so many layers in this. Jensen likes to talk about layers. There's a lot of layers in this. And I think there's clearly lots of enthusiasm right now. But if you're talking about multi-year horizons and trillions of dollars of CapEx for the foreseeable future, um, it is. I understand why people are getting a little wobbly on this.
Yeah, yeah. I think again, I think it comes back to the amount of the return, which again has a number of variables, which is obviously utilization of the GPU, price that you can charge, and all of those being normalized above your hard costs in construction and power over the length of time. Right, your fixed one-time cost versus what's amortized over the length of your GPU value for those particular assets. And again, it's yeah. I mean, we have a gigawattonomics model. We've talked about before. I can run all these assumptions down to it, and again, come back with all the assumptions you need to validate CoreWeave. Right? How much do they need to charge per hour? At what utilization? Like we could back into that, right? We could even show how much it makes. In fact, I tweeted this: how much that on a 10-year, assume a 10-year life, which again, Microsoft and others are saying they're going to extend this to 20 or 25 years. I can't remember, but assume a 10 years life and average economics. So 650 an hour, 75% utilization. And we came back with just over 200% return on that capital, right? In that one scenario. But you're right. The issue is, do those investments stop, or do those investments have to keep continuing? And I guess, and unless again, unless you tell me I'm interpreting this wrong, but Jensen saying that compute is an investable asset, I think has to assume that it keeps going. It doesn't invest and stop and depreciate.
Apple farmer says apples cure all illness, right? I, look, I'm not saying that this is all bubbly and this is never going to happen. What I'm saying is nobody knows. Nobody knows where this is going to be in 5 years from now. And the problem we're having now is we're starting to sign long-term debt agreements which extend out 5 and 10 years. And I think it's very, very hard to forecast. Absolutely, today I can build a model that shows payback on these systems is very strong in
Yeah.
2 years, right? But the scale we're going to, especially with prices increasing, like remember Jensen saying prices per gigawatt are doubling. Um, at you're signing these long term agreements. I think nobody should have anybody who expresses a high degree of confidence that this is going to be saleable. We're still going to be selling Ampere systems 5 years from now, maybe, but nobody knows that. And so I think there's and again we're dealing with bond investors. Bond investors don't care about AI; they care about when they're going to get paid back. And so far, they're willing to take that bet because the near term numbers are so good. You can get pay everything back in 2 years. But I think with the numbers getting as big as they are, that gets more challenging.
Yeah. I mean, generally, like I've talked with people who work with some of these GPU as a service companies on rates of return, and they have been seeing their there is aided financing be paid back in 3 years pretty consistently. So again, that's happening. I think the point that we're dancing around though is again like when you say something's an investable asset, and I get your point right about farming and and apples, but next year's apples. I don't take my God. I'm going to completely bork this analogy. I don't I don't replace portions of my apple farm with new trees that double performance of my apples. Yeah, I just borked this. But do you see
That's
what I'm
good.
saying?
Yeah,
Like,
yeah,
so you have to keep you're in anyway.
yeah. That's right. And I just know when you build out these models, that becomes a major factor, right? At some point, you need to get to steady state where they're generating cash
Absolutely.
flow. And look, they're like Amazon did that. AWS did that. They went through years of losing money, and now it's hugely profitable. But it was on a much slower upgrade cycle, and the expense was much lower relative to the
Yeah.
economy.
Yeah. I mean, but at the same time, like I don't think Amazon, I'm gonna mention them specifically, like wouldn't disagree that as they were building AWS and they continue to sustain and run AWS, that their infrastructure and continuing to invest in that infrastructure was not a valuable use of their money. Like they monetize that to run Amazon.com and host people's email and SaaS servers and whatnot, and that business was sustainable, and they made money on it. So AI is similar. The other point I'll make is I think NVIDIA likes this idea because um, it widens the pool beyond the neo clouds, and I do think there is some sensitivity around the neo clouds wanting to compete with the hyperscalers that is hurting some of their potential relationships long term with those hyperscalers, and the hyperscalers and other labs are sitting there saying we need more compute. So if it was there, which is why I think the likes of Crusoe and Lambda and some of these others are attractive as partners for said hyperscalers or frontier labs for compute. Um, that I think that they can have pretty attractive economics for their margins for people who want to do kind of spillover from their own infrastructure into some of these new data centers that are going to get built that are really just pure AI factories, right? Not trying to be a like a neocloud is, like not trying to be a hyperscaler. Um, so I think there's a dynamic here at play as well.
Yeah, and I think, I mean, this is where I start to really push back on Jensen's language, because he's not saying that compute is an investable asset. He's saying compute is a whole new class of investments. You'll have stocks, bonds, currency, real estate, and compute. And I don't think that's true because of all the reasons you just mentioned, right? Land doesn't get obsolete, right? You don't need to keep, you can't make new land. Like it's not the same category of things. This is debt. It's a form of debt, right? Maybe a little equity mixed in, who knows? But I think there is a real tension here where Gen- NVIDIA wants everyone to keep upgrading and buying new systems every year, and it's getting hard to do that. It's getting very expensive.
Yeah, I know. I mean, I think this happens for the foreseeable future because the TCO of each new generation and then revenue per watt with the latest generation is going to be good. My point, though, is over the course of 10 years, is that true? That in 2035, next year's compute is 20, 30, 40% better than last year's. Again, like I said, maybe I'm thinking about this wrong, and that's not the right way to think about it. And you're just going to do rip and replace 20% of your infrastructure every 6 years. Fine, but my hunch is that to make the claim what you're saying to some degree necessitates very little obsolescence.
I think in I think it's too hard to say too far out because I could see it either way, right? I'm not, again, I'm not playing bear here. I'm just saying, if AI keeps improving at the rate it's improving and becomes more and more useful to people, and it actually starts, coming up with cancer cures, then we could very well be in a place where we still don't have enough compute 10 years from now.
Yep.
But my intuition is that it will not be an even move. It won't keep going up into the right forever. And we could very well be in a position where at some point in the future where we have too much compute, at least for the moment. And I just don't think anybody knows. That's the honest answer. Nobody knows. Right.
Right. And I think it's that bit that weirds everybody out, to be honest with you. And I totally get it. I get the tension. Like I said, I could see it both ways. Like
Yeah.
I pointed out before, if this workload is like graphics and visual arts, it just keeps going. Every year you need more because you're chasing fidelity. And if you're chasing AGI and we don't really get there, or it's always the next bit of infrastructure away, I get it. So you're right. But I think that's the sensitivity to it is it's hard to grasp the vision when you just don't know. Like logically, you could see both sides. So time will tell.
Right.
Time will tell. But I mean, for the foreseeable future, we're compute constrained. So that is at least our common denominator. So, all right, everybody, thanks for listening, and we will talk to you next week.
Thank you, everybody. Click like, subscribe, tell your friends.